Thank you all. Good morning. Thank you all very much for coming. As Nick mentioned, my name's Andrew Summers. I'm Head of Collectives and Fund Research at Investec Wealth and Investments. We run about £28 billion of money, of which about £3 billion is invested in investment companies. So that makes us one of the largest investors in the sector. Now, I'm very conscious of the adage that the only reason that God created fund research analysts was in order to make weather forecasters look good. But I will nonetheless try and provide some insight into the world of investment companies today. And I'm also very conscious that my job is to talk and your job is to listen. And my challenge is to make sure that I finish my job before you finish your job. So I'll try and do that within 30 minutes. So I hope to do that today by following the agenda, a practical perspective on how to research and analyse investment companies. I hope to do this by highlighting the key differences between investment companies and open-ended funds, taking you through our framework for how we analyse investment companies by looking at the three main categories of investment trusts in our world. Now, there are important differences between open-ended funds and investment trusts, which require specific due diligence and ongoing monitoring of investment companies. These differences do mean that you need to take careful consideration of investment trusts when you are constructing portfolios. And then finally, I'll wrap up with some concluding remarks. So let's kick off with a quick revision lesson. It'll be very, very quick. Investment companies are closed-ended and they have permanent capital. They can gear. Investment trusts can trade at a share price rather than an NAV. Now, this is a real mixed blessing, but it can also provide a real opportunity if you have the expertise to take advantage of this. Now, what it may do for non-equity strategies is that it may mean that your investment has a higher correlation to equities than the underlying assets in the investment trust, or the open-ended fund equivalent. And it may also mean that there is more volatility in your investment than if you were invested in the underlying assets or if you were invested in an open-ended fund equivalent. And the extent to which the share price deviates from the net asset value can be controlled to some extent by the board of directors. And it's very important that we understand how and when that board of directors may or may not try and influence the premium and the discount. And fourthly, because investment companies are companies, they have the ability to use accounting rules available to them to create reserves that can smooth and augment dividend payments. The investment company sector is about 1/10 of the size of the open-ended sector in the UK, and I think that's a pretty good rule of thumb for the kind of percentage of a typical portfolio that you should be looking to have invested in investment companies, about 10%. Okay. So I said a moment ago that we split the investment company universe into three main categories. The first main category is investment companies which invest in areas that you just cannot access via open-ended funds. Investment companies are the only show in town. That's about 10% of the universe. The second area is areas where you can access the strategy or the asset class via an open-ended structure, but you can also access them via investment companies, and the investment company structure is a preferable way of accessing that asset class than an open-ended structure. And that's about 1/3 of the universe, in my opinion. Then about half of the universe is areas where the investment company strategy or asset class can also be accessed via open-ended funds, and there is not necessarily a huge benefit to accessing that asset class via an open-ended structure. Now, I am very conscious that those numbers do not all add up to 100, okay? Which kind of reminds me of the old adage that there are three types of people: those who can count and those who can't. But these are just very, very broad numbers. Right, so let's take the first main category, okay? Where investment companies are the only option in town. Now, there are actually very, very few areas where you can really only invest in strategies via an investment trust. Okay? It's principally private equity, some hedge fund strategies, and some very illiquid credit strategies and non-UCITS compliant strategies. Okay? Now, the main thing all these have in common is that they invest in assets or strategies which are simply incompatible with a regulated, open-ended format. Remember, investment companies are companies. You can put virtually anything into a company. Right? Private equity. The illiquidity of the underlying assets makes the alternative, a 7-year plus lockup LLP structure, simply not an option for the vast majority of investors. And in the case of hedge funds, I've listed a few here, without the investment company structure, you would struggle to invest with any of these managers because their open-ended funds are either closed, not available to retail investors, or have very long lockups. So let's look at the hedge fund example in a bit more detail. These are just some examples here. We've got 3 hedge funds here. We've got Brevan Howard, we've got Winton, which is the Ascension Fund, we've got Bluecrest. These have all done reasonably well in total return terms and certainly very well relative to cash, their benchmark, and with much less risk than equities and with very little correlation to equities. I've got a question for you. How many of you here think you will make money in real terms out of gilts over the next 5 years? Okay, so where are you going to get your uncorrelated returns from? This might be a good place to start. Okay. Now note, in 2008, in periods of extreme stress, these share prices will sell off along with everything else. Okay? Everything correlates to one. But look how quickly those share prices bounce back. Now, in addition to private equity and hedge funds, the third main area where investment companies are the only option is in illiquid credit strategies. And you can see here some of the attractive yields on offer in the listed credit space. Now, this is a huge area for us. We've invested over £200 million in the last few years in these kind of strategies. Our demand has come from the continued hunt for yield in a low interest rate environment. And the supply of these strategies has come from bank disintermediation. As a result of regulation and stricter capital requirements, banks are offloading a lot of these illiquid assets. And the investment company universe is uniquely placed to take advantage of these. If you know the gross redemption yield on offer of these assets, but all you have to do is hold them to maturity, then buying them and owning them in an investment company format where there is a permanent pool of capital so you do not have to sell them before they reach maturity is very, very attractive. And we are seeing lots of innovation in this area. Peer-to-peer lending is the next big thing in this area. It's not necessarily going to be for us, but it is an example of the innovation that is coming. So we've covered the first area where you can really only buy certain things via investment companies. Now let's look at the second area. Areas where you can also buy these assets and these strategies in an open-ended format, but we believe that the investment company structure is preferable. Now this is a real rich hunting ground for us, and it's an area where if you have investment company expertise, you have a real competitive advantage over your competitors who can only go via the open-ended option, even though the investment company option may well be preferable. Now, we will come on to these in more detail, but we all know of open-ended funds that invest in physical property and infrastructure in smaller companies, funds, and in semi-liquid credit strategies, and also equity income strategies. All those vehicles, all those strategies are also available in investment trust, in investment company format. And we believe in most of those cases, the investment company format structure is preferable. So this slide focuses on physical property. Now, for obvious reasons, liquidity of the underlying assets, physical property naturally lends itself to a closed-ended format. Open-ended funds investing in physical property need to also sit in cash to fund daily redemptions. If you are sitting in cash, that creates a drag on your total return, and it creates a drag on your yield. If you don't sit in lots of cash and you face lots of redemptions, we all remember what happened in 2008 when these funds were gated. Taxation is another less well-known consideration. Every time an investor goes into an open-ended fund, if Investec buys £10 million of an open-ended fund, that fund manager has to buy a building. That building will cost at least 5% in costs. Now that 5% in costs will either be borne by me as the investor, as the new investor into the fund, or it will be borne by existing investors. Either way, that cost is borne by somebody in the fund, because you cannot get away from the fact that if a manager is taking an inflow into a fund, they have to buy a building and that incurs costs. In contrast, if I buy £10 million worth of an investment company, there is no inflow. I've just bought the shares. The capital is permanent. The fund manager doesn't have to buy a building. There are no transaction costs. I do not have to pay stamp duty as a result of that inflow, either as a new investor or as an existing investor. Gearing is appropriate if it's modest and where it is used mainly to gear stable cash flows, and commercial property is a good example of that. And finally, a slight nuance on the permanent pool of capital idea. I estimate that in 2014, UK physical property managers had to invest about £4.5 billion. Now that compares to about £500 million of equity that was raised by the boards of property investment companies. Now what that means is that the boards of investment companies, property investment companies, that have the choice about when to take in money, okay, they can decide when to raise equity or not, chose not to raise as much money, nearly as much money, as the fund managers of the open-ended sector were obliged to take in because their funds are open-ended. Okay, and I think that's very instructive. Now, why not? Well, because yields were coming in sharply, and if you are an investor in a fund which is receiving lots and lots of daily inflows, which are being invested at ever higher prices in the property market, as an existing investor, you are being diluted. If you're an investor in an investment company where there are no inflows, you are not being diluted, because there are no inflows and the fund manager is not being forced to invest those inflows at ever elevated prices. Now, having taken you through some of the advantages of the investment company structure for property funds, obviously there's some disadvantages as well. So there's some good news here and there's some bad news. Now, how many of you here used to watch The Office with Ricky Gervais? Any of you fans? Right, so when I'm talking about good news and bad news, it reminds me of the scene where David Brent gets all his guys together and he says, look, I've got some good news and I've got some bad news. He goes, the bad news is you're all being made redundant. The good news is I've got a promotion. And then he looks around all the sullen faces and he goes, you're still focusing on the bad news, aren't you? So there's some good news and there's some bad news. And it relates to what I was saying earlier, which is that physical property, as measured by NAV, will in most circumstances have a lower volatility and a lower maximum drawdown and a lower equity correlation than the share price of the investment company. And that is understandable, because every time you create an investment company, you're creating an equity wrapper which is offering daily liquidity, and it is bound to be impacted, as Nick said, by the sentiment of the market. But as we shall see later, we believe that this volatility provides an additional opportunity to be able to buy and sell investment companies at dislocated prices, which is an opportunity that you just don't have with with open-ended funds. Now this graph shows another danger of investing in investment companies. The black line is the IPD, it's the benchmark. The light blue line is the open-ended investment company sector, open-ended property sector, and the dark blue line is the closed-ended, listed investment company sector. And as Nick said, what you can see is in 2008, just before the NAVs start to tail off, the share prices start to wobble, and then all hell breaks loose when these capitals start to fall. And what you can see from the dark blue line is this was exacerbated by the effects of gearing. Falling values with gearing, big problem. So that's phase one. Properties, you get a wobble. Then phase two, all hell breaks loose. But of course, look at the bottom. If you'd have been smart enough to invest in January 2009, the average UK investment company property fund was trading on a 40% discount to NAV. And it was only a couple of months later that the sector's total returns started to turn positive again. So if you were brave enough and you invested in the right vehicles, because there's a lot of dross in that sector by that point, but there's still a lot of pretty good companies with pretty good assets and balance sheets that weren't completely out of whack, you could have generated a pretty nice return. And of course, you can see that with the good news, which is in the recovery phase, NAV is going up. You've got gearing. Happy days. Okay, investment companies will almost certainly outperform open-ended funds. Why? Because the investment company has gearing, whereas the open-ended fund is probably sitting in cash. The investment company is not having to invest new inflows at ever higher valuations, whereas the open-ended fund probably is. Another example of an asset class that works well in an investment company structure, but you can invest in also via an open-ended fund, is infrastructure. The light blue line here is the investment trust infrastructure sector. The dark blue line is an index of global infrastructure companies, and then the black line is the FTSE All-Share. Open-ended infrastructure funds have to invest in infrastructure companies because they're not allowed to invest in actual infrastructure assets. Okay? And they're going to invest in companies such as Argon in the US, which invests in power systems, wiring, and utility construction businesses. But compare that to an infrastructure investment company. They can invest in the concession to operate an actual toll road, the M40, an actual hospital, an actual school, an actual courthouse, an actual prison. Nearly all these cash flows are backed by the UK government. They are RPI linked for 20 years. And these companies are yielding about 5%. Now, we think that is a very, very attractive investment proposition. Now, in 2008, a lot of these infrastructure funds sold off along with everything else, okay, as I mentioned earlier. But they soon bounced back when the market realised that the UK government was going to carry on paying for that toll road. They were going to carry on paying the concession owner for that hospital and for that school. Okay, it's as good as gilt in terms of the credit risk. So even with the equity wrapper of an investment company, in the example of infrastructure, the correlation between infrastructure investment companies and the FTSE is about 0.15. So very, very little correlation. Whereas the average open-ended infrastructure fund has a correlation to the FTSE about 0.8. Okay? So from a portfolio construction perspective, and then from a diversification perspective, investing in investment companies owning infrastructure is a lot more attractive than investing in open-ended infrastructure funds. I won't dwell on this. Nick has mentioned this very, very well already, but clearly the ability to retain and smooth out your dividend flow is very, very important for investment companies. And with an aging population, the benefits that investment companies have over open-ended funds in terms of being able to smooth out and provide a progressive, sustainable dividend is really, really important for this sector. And some of the older investment companies have accumulated years and years of reserves. So one of the things we look at when we're deciding which investment companies to buy for our older clients that want income is to go through the reports and accounts and really understand how big are the income reserves. How many years of falling market dividends could this company endure before it had to cut the dividend? Okay. So now let's look at the third area. In my opinion, the largest category. And this is where investment companies invest in assets and strategies which can also be bought in open-ended format, and which, on paper, an investment company format doesn't really offer necessarily many benefits. Now, these are mainly liquid, large-cap equity strategies. Okay? So there's two potential areas of interest here. One is playing the premium to discount, and the second is playing the gearing. Taking gearing first, now we know that gearing is a high-risk strategy, especially for equities, and especially if you're not gearing an equity strategy which has an income focus, where at least the objective is to gear a relatively stable dividend stream. And the majority of standard equity investment companies don't use material amounts of gearing, and I think that's probably right. Thus, it's really the ability to play the premium and discount game here, which is most important. And the classic example is when one buys an investment company in a sector which is out of favour, so it's trading on a discount. Okay? That sector then comes back into favour, and not only do you then benefit from a rising NAV, but you also benefit from more people buying the shares of the investment companies in that sector, so that the discount narrows. The share price of the investment company outperforms the NAV of the investment company. The NAV of the investment company is probably outperforming the NAV of an open-ended fund because it's got some gearing, and you've got quite substantial outperformance. So to recap, certain illiquid and non-UCITS compliant strategies are only available in invested company format. If you do not invest in investment companies, you are missing out on a large and growing sector of the market, which is increasingly important, especially when you're talking about income-related strategies and an aging population. There will be many asset classes and strategies which you can buy in an open-ended format, just as easily as you can in an investment company, but where the investment company structure, through gearing, dividend smoothing, and a fixed capital base, provides real relative advantages. As a consequence, many investment companies will outperform their open-ended equivalents, or simply will be more attractive. So now let's have a look briefly at premiums to discounts. Nick touched on this already, so I'll be very brief. I mean, clearly buying assets at a discount to NAV has its obvious appeal, but it's crucial to understand the reasons for that discount and to believe that that discount will narrow. If you don't think that discount will narrow, buying something on a discount is of no advantage to you. Okay? Similarly, avoiding buying things on a premium makes no sense if you think that premium will be sustained, or indeed if you think that premium will grow. In other words, investment companies trade at discounts and premiums, and their discounts and their premiums to NAV vary for a multitude of reasons. And it's very important for us as investors to understand what drives those re-ratings. Assess an investment company as you would any other company. Look at its absolute valuation. Look at its valuation relative to its own history. Look at its valuation relative to its peers. A couple of examples. Before I move on. As I mentioned earlier, an investment company's board has the ability to control the premium or discount to NAV. When a company is trading at a premium, it can issue shares, which has the effect of bringing the premium down. If an investment company is trading at a discount, it has the ability to buy back shares, which may, if done appropriately, have the effect of narrowing the discount. There are various other ways a board can manage the premium and discount as well, and it's very, very important for investment company investors to understand the board's policies and its ability to manage that premium or discount. I think, the last time I looked, about 20% of investment companies in the universe have explicit discount control mechanisms. Okay, so not many. And not all of them are successful. So an example, the light blue line here is the emerging markets investment trust sector. The dark blue line is the European investment company sector. Now, the EM investment companies look ridiculously cheap relative to European investment companies. In fact, the gap has probably never been wider. And EM investment companies look cheap in absolute terms at an almost 10% discount to NAV. Yet, in relation to their own history, emerging market investment companies don't look like a screaming buy. They look like an interesting buy. Whereas, in contrast, European investment companies look about as expensive as they've ever been. But again, there is no reason not to buy European investment companies if you continue to be bullish on Europe, if the investment company you're buying is geared, and if you think that Europe continuing to be in favour will actually lead to that sector going to a hefty premium. So you need to look beyond the headline numbers to really understand where you think the valuation lies. Another example here. Here we've got the property specialist healthcare sector. This is basically GP surgeries. Okay? And the bottom line is the private equity fund of fund sector. Now, premiums and discounts to NAV are, of course, a measure of the difference between a share price and an NAV. Now, you can't question the share price. The share price is what the share price is. But you may question if you believe the NAV. And if you actually think that the NAV is different to the published NAV, then actually the headline premium or discount may be different. And I'll give you an example. Take healthcare property. Now, why would you buy anything that's trading on a 25% premium to NAV? Okay, well, GP surgeries are very solid assets backed by the UK government, and the yield which value was used to value these assets is about 5.5%. Now, I think that yield is way too high to value an asset of that quality. If you valued the assets of that sector at a lower yield, the NAV would go up, and all of a sudden that sector isn't trading on 25% premium. It's trading on a much, much lower premium. And therefore it is arguably much, much more attractive. So make sure that you actually believe the NAV. There's nothing immoral or illegal about the way the NAV has been calculated. It's simply you may decide that you have a different view on actually what the NAV is. And that would therefore obviously knock on to you having a different view of actually what the real discount is. Converse for private equity fund of funds. Private equity fund of funds typically trade on discounts. They do that because there's a lot of uncertainty about the value of the underlying assets and there's a lot of lack of transparency. But in the case of most of the private equity fund of funds we invest in, when they sell an asset, they are selling it at quite a substantial uplift to the last value that it was carried at for NAV calculation purposes. So if you actually believe that the NAV of a lot of these private equity fund of funds in reality, when they're realised, is higher than published, thus the discount as published is actually